that gold is $3,000 an ounce is, it's surprising that it happened this fast, but it's not surprising that it's there. And the people who run the numbers of what gold has to go to in order to actually be able to back the world's fiat currencies say it's got to go a lot farther. 10,000 is the minimum number that you see when people are talking like this and running those numbers. So $10,000 an ounce gold is coming. The question is, will $20,000 or $30,000 an ounce come? That's a scary world. So it's exciting for stackers, but terrifying for basically everybody else if we end up with a world where the fiat currencies are so devalued that gold is now $30,000 an ounce. But it's a completely feasible, completely possible world, which is why we should all be acquiring precious metals.
The rapid rise of gold to $3,000 an ounce occurred faster than expected, but it's not surprising given the global monetary backdrop. Experts projecting a return to a gold-backed system say prices would need to rise much higher, at minimum $10,000 an ounce, and possibly even $20,000 or $30,000. That kind of surge would signal significant fiat currency devaluation, creating a scary economic environment for most, but a major win for those who've been stacking precious metals. The speaker, John Rubino, a prominent personality in precious metal analysis and predictions, explains that gold has surged past $3,000 an ounce because people seek safety during global chaos, trying to avoid unnecessary risk. Countries like China and Russia are moving away from the US dollar and stocking up on gold to prepare for a possible new financial system. Banks are also buying more gold since it's now considered a top-tier asset under Basel III. Unlike in the past, gold passed the $3,000 mark easily because buyers, including central banks, aren't sensitive to price. These factors are driving steady demand for gold, despite uncertainty about the future. Moreover, fiat currencies are losing value due to years of inflation and financial mismanagement, especially in the West and parts of Asia. Since bonds are tied to cash, they're also declining. Most countries are deeply in debt and constantly printing more money to stay afloat, worsening things. The exception is Russia, which has relatively low debt. Eventually, this will likely lead to a new financial system involving a gold standard or something similar. That's why central banks and savvy investors turn to gold as a safe, long-term asset. Let's jump into the video for more details. If you like what you see, please thumbs up and subscribe to our channel to stay updated with our latest content.
Gold is where we hide out in times of chaos, and so that's one explanation for gold going up. Plus you've got the BRICS thing going on and this predates a lot of the political turmoil in the US and Europe, but a lot of countries have just gotten sick of the US using the dollar as a reserve currency weapon against them. So they're taking steps to protect themselves should they have to go back to some kind of gold standard or just start bypassing the dollar in trade. And so their central banks, especially China's and Russia's, have been buying gold aggressively for years now, and they haven't been very price sensitive. So that, in part, explains why the price of gold has gone up more or less steadily, while other things have bounced around in such a crazy way. And then you've got the Basel III thing going on, where global banking regulations have changed. And gold's status has been upgraded from a tier 3 asset, which you had to hold reserves against gold if you wanted to own it if you were a bank. They've upgraded it to a tier 1 asset, which is the reserves that you hold against other assets. And because of that, a lot of the banks in the world are accumulating gold alongside their treasury bonds and their US dollar cash as tier 1 assets. And they don't seem to be too price sensitive either. So that's kind of why gold, add all that up. And that's why gold pierced $3,000 an ounce so smoothly. Normally, you would expect that to be massive resistance, right? Because traders, humans in general, but traders in particular, like big round numbers. And when an asset gets near a big round number, you expect a lot of trades to be input there. And when something is going up to hit that number, then the trades are sales, and they knock the asset back down. It took gold like 4 years and multiple attempts to get beyond $2,000 an ounce. And this time around, it just blew right through 3,000 with no trouble. So anyhow, that's in part why. There are just a lot of reasons for people to be buying gold and ignoring the price as they do so. Now, whether that continues or not, there's no way to know, but that explains the recent past. We know that we're inflating away and generally mismanaging all the big fiat currencies, right? So that they're losing value is to be expected just based on the amount that we're creating. And that's been the case. We've had inflation in the West and parts of Asia for a long time. And that's cash going down in value. And that's also bonds going down in value, because all bonds are is proxy for cash. They just pay you cash, and that's where they derive their value. So no surprise that everything else left off the table, just our financial mismanagement of the past 30 years, should be leading cash and sovereign bonds to lose value, both in nominal terms and relative to gold. So yeah, we are creating basically Banana Republic world right now. And almost nobody is immune to this. Basically, Russia is the only country that's not really debt ridden, and I guess Switzerland, although they're more like a banking sector that calls itself a country. So, but Russia's a major country, and they don't have a lot of debt. But everybody else, we're all wildly over indebted. We all have to create huge amounts of new currency in order to manage our debts. And other things being equal, that's going to lead the currencies and the bonds that are based on them to go down in value over time. Now, gold is probably the end point of this process. We're going to have to, at some point, declare a new Bretton Woods agreement that might be a flat-out gold standard, or might be something that's some kind of hybrid standard. Who knows what they'll come up with and whether it'll work, but gold will be involved in the next financial system. So if you're a central bank or an individual investor...
John Rubino, in a crosstalk with Kai Hoffman at SOAR, financially recalls, "The bear case for gold is that during a major recession, like in 2008, panic selling could drag gold down with everything else, even though it's a haven. If markets crash, investors may be forced to sell gold to cover losses elsewhere. But if that happens, it could be a great buying opportunity because governments will likely respond with massive stimulus and rate cuts, boosting gold long-term. So, while there's a short-term risk, the long-term outlook, like $10,000 per ounce gold, still looks strong. Accumulate gradually and stay patient." John Rubino also exposes that gold miners usually surge when gold prices rise, but this time they lagged because mining costs, like oil and wages, also jumped, cutting into profits. However, now gold is up enough to outpace those costs, and miners are starting to show strong earnings and cash flow. If gold holds steady, miners could become very attractive as they pay off debt, boost dividends, and improve operations. Now, let's redirect our attention towards the interview.
The bear case for gold is that we tip over into another recession. Because look at it historically. Back in 2006, 2007, 2008, we were beginning to tip over into a recession, and that it hit in 2008. And stocks just tanked. We had a brutal bear market in equities, and that pulled down everything else. Gold and silver both went way down for a while in 2008. And then the government stepped in and central bank stepped in with massively easy money, and everything went back up. But you had this V bottom in precious metals that had really nothing to do with precious metals. It was just that stocks were tanking, the banking system was on the verge of collapse, and maybe gold was the only thing that hadn't gone down yet for you. So you had to sell that because you were going to get margin calls on your banking stocks and your tech stocks. That could happen again very easily. Gold. Let's say gold holds up. Tech stocks roll over, everybody gets terrified, and then you could easily see selling in precious metals along with everything else that takes gold and silver down harder than is easy to imagine right now. Just because panic, when people are panicking, they do extreme things. And that could happen. If it does happen, it's an extreme buy the dip situation for precious metals. Because governments will have no choice but to devalue their currencies when the next big recession and equities bear market hit. So you'll see the central banks coming back in with, 2 percentage point cuts in interest rates, and a lot of the countries of the world will go back to negative interest rates. All of that is coming in the next recession and equities bear market. Gold and silver won't be, well, they might not be immune to that, because it's possible that this time around that people understand what's happening, and they've got enough recent history to see that central banks are going to come in aggressively with easy money the minute the NASDAQ drops by another 20%. And I want to own gold for that. And so gold catches a bid in anticipation of that easy money. In other words, there's no real way to know exactly how this plays out. And there's a risk to precious metals as we head into a recession. But there's also a big opportunity there if they get smacked in, say, a 2026 equities crash or something like that. So again, don't jump with both feet into anything. Just accumulate a little bit at a time, and assume that you're going to be okay in the long run. Keep the ultimate prize of $10,000 an ounce gold in mind, and then it makes these squiggles along the way less scary. Surprising things about this precious metals bull market, because normally, they call gold and silver mining stocks leverage plays on the underlying metal. In other words, they're like options that you buy if you expect gold and silver to go up, because those options will go up even more. You have a leveraged bet on gold and silver. Didn't happen this time. And I think a big part of the reason why it didn't is that as gold went up, so did the cost of gold mining, because oil was up, and wages are up everywhere, and that was making it more expensive to mine gold, which canceled out the higher gold price for a lot of gold miners. It stopped them from being able to report dramatically higher earnings and cash flow. But then lately, the price of gold has gone up enough to more than offset the cost of gold mining. And so you're seeing a lot of gold miners report pretty good numbers. We're in the middle of earnings season right now. So your audience should be watching what the gold miners report, because a lot of them, they're seeing gold be up by almost $1,000 an ounce over the previous year's first quarter and second quarter. And that's giving them massive cash flow, because their costs are up some, but not that much. So all that extra cash is just flowing down to the bottom line. And that makes a huge difference. So I think that if gold doesn't crash from here, if we don't get a big correction and gold holds its own, then the gold miners are going to be a really attractive sector. Because first of all, they're going to be putting up really good year-over-year comparisons just across the board, from revenues all the way down to free cash flow. And then they're going to be using that free cash flow to improve themselves. They'll pay off their debts. They'll raise dividends. They'll buy back stock. Maybe they'll make strategic acquisitions, although that's a good news, bad news thing for the mining industry. But in general, they'll become better companies thanks to all this free cash flow. So you've got the excitement that comes from a bull market, and then you've got the improvement operationally and financially for a lot of these gold miners.
Gold's rapid climb past $3,000 signals deepening concerns about fiat currency stability, global economic mismanagement, and rising geopolitical tension. While there's potential for short-term volatility, especially in a recession, the long-term fundamentals for gold, and now even for gold miners, remain compelling. As central banks and informed investors continue shifting toward precious metals, gold may play a central role in whatever financial system emerges next. Do you think central banks will move toward a gold-backed system, or is it just speculation? Given the current trends, are you considering investing in gold or gold mining stocks? Let us know in the comments below. For more content like this, don't forget to subscribe to our channel, hit the notification bell, and explore our other videos. Thanks for tuning in.